Have you ever wondered where money really comes from? Most people would think the answer is the government or central bank. But what if I told you it's actually the private banks who print most of our money out of thin air with just a few keystrokes? In this video series, we'll explore the credit creation theory as championed by Richard Werner, an Oxford educated economist, creator of the concept quantitative easing, and author of the bestseller Princes of the Yen, who has published the single most seminal work on the Japanese everything bubble and its subsequent collapse. This will be part one of a series that will explore the link between this credit creation theory, the silent depression, hyperfinancialization of the US economy, and globalization, hopefully tying everything together. So, we have this paper that was written by Richard Werner that talks about where does money actually come from? Can banks actually print money out of thin air? Spoiler, they can, and he proves it in the paper as we will take a look at in a second. But first, we have to establish what is money. How many dollars are there? Surprisingly, there is no one way to measure the money supply. Here are a number of different ways of thinking about it. For example, the monetary base, this is currency, actual physical currency, plus what are called bank reserves. We've talked about these. These are dollars created by the Federal Reserve that are held in an account, right? JP Morgan has an account at the Fed. They hold their reserves at the Fed in an account at the Fed. Those are reserve balances. They were created by the Fed. That is part of the monetary base, or you can think of this as official money or the base money. Well, that's only 5.7 trillion. Well, 18.5 trillion in bank credit. Why is bank credit on here as a way to measure dollars? Well, if I go to Wells Fargo and request $1 million mortgage, I get $1 million. As we will see, the bank just created that out of thin air. So we have to look at how many loans or credit. It's two sides of the same coin, right? One man's debt is another man's credit. We need to look at the total amount of that credit. Well, that's 18.5 trillion. Then there's M2 money supply. This is the broad way to measure the money supply. That is 22 trillion. This includes things like deposits in a checking account or a checkable deposit like a CD account. But it gets even worse. I mean, we're already talking about 4x leverage from M0 over M2, right? 22 to 5 trillion. Well, it gets even worse. If you total up all the real estate value, that's 40 trillion. And the reason we're looking at this is if you sell your house, you are going to expect that you get dollars. Then, of course, there's the stock market as well, which is $62 trillion. You go to sell your Apple shares, you expect to have dollars in your brokerage account. Well, we established there's only 5.7 trillion of actual real official government created money. So how is there $62 trillion worth of value in the stock market? How is there $40 trillion of value in real estate? Well, we'll see as Richard Warner proves in the paper, banks are printing money out of thin air. If you add real estate, equities, and the national debt, some might argue about the national debt being double counting. But remember, when a treasury, when someone buys that treasury, we are just promising to repay dollars at some point in time. But also, that debt is sellable on the open market in the secondhand market. You can go and sell that U.S. Treasury, and so to some degree, I would imagine national debt should be factored in this as well. Now you're talking about $139 trillion. Well, again, there's only 5.7 trillion of actual government official money. This paper, which I will link to in the description, Can Banks Individually Create Money Out of Nothing? The Theories and the Evidence. So I read through this a couple times. I made a couple notes. I will briefly summarize this paper. You can read it in full. I will link it in the description. But there are three main theories. There's the financial intermediation theory. This is basically that a bank is just shuffling money from one account to another, right? I go deposit $100 and the bank makes a loan from my money that I gave to the bank. The bank can only loan out however much money they have in deposits. They're just shuffling from one account to another, only loaning out money that they have in another account as a deposit that someone else deposited. Then, of course, there's the fractional reserve theory. This is a similar kind of intermediary theory where a bank is just an intermediary, but as a whole, right, the bank itself cannot create new dollars, but the banking system can create new dollars. And we'll see how that works in theory is not proven to be correct by his test at the end. But under the theory, the bank must hold some amount of money. Going back to the reserve balances, let's say that Wells Fargo has 1 trillion out of this 3 trillion. Total bank reserves, Wells Fargo has 1 trillion of that. Well, what that means, if there's a 10% reserve requirement, the Wells Fargo must keep 10% of however many loans it writes. It must keep 10% as real money, liquid US dollars, sitting in a vault. It's not actually in a vault, it's an account at the Fed, but they must hold some amount. So they are limited by their bank reserves onto how many new loans they can create. This is the fractional reserve theory. Then, of course, there's the credit creation theory, which is that banks can just print money out of thin air. This is what he proves to be the actual empirical fact of how our banking system works. Of course, he also notes most macroeconomic and finance models do not even include banks, even though it is proven that that is how our banking system works. Banks are printing money out of thin air. You would think our models would include banks and bank loans, but they do not. He also points out that the conventional view currently is this kind of intermediation theory where a bank is just shuffling money from one account to another. I give Wells Fargo $100, they can then loan that out to someone else, but there is no new dollars being created. Well, of course, we know that this is not true already from looking at M2 versus M0. There's leverage of 4x, and that's before you get to real estate or the stock market or other less liquid dollar markets. There's already 4x leverage just between M0 and M2, so we kind of already know that that's not correct. Then, of course, there's the fractional reserve theory. This is what we talked about. If Wells Fargo has $1 trillion of bank reserves and there's a 10% reserve requirement, Wells Fargo can loan out $10 trillion. But if they want to loan out 11 trillion, they must increase their reserves. They must have 10% of their total loans as liquid cash reserves. This is the fractional reserve theory. This was the predominant view from the early 1900s up until kind of the mid 1900s around World War II. Then, of course, he notes that there's confusion. No one really understands how the banking system works. And the Bank of England themselves, with one of the most powerful countries in the world, the Bank of England's own statements contradict each other. They endorse all three different theories, even though they are mutually exclusive with each other. The central bank staff are on record supporting each one of the three different theories at the same time. He notes also that modern regulatory frameworks are on a false premise. They are based around a theory of how the banking system works, how money creation works, this intermediation theory, which is not correct. This is where Basel III, these various frameworks you might have heard of, they're structured around a theory that is proven to be not how the banking system actually works. So in terms of preventing crises, that's not the most reassuring thing. So this is the credit creation theory. This is the first one he looks at. He goes through, he did a literature review, and there is an extensive amount of literature going back to the 1800s where this credit creation or banks printing money out of thin air was endorsed and spoken about by many different economists going back again, hundreds of years. There are quotes here from various papers he found that talk about this bank credit creation, where the bank is just printing money out of thin air. Again, I will link to this in the description. The second theory, of course, is the fractional reserve theory. This is that the bank must have a certain amount of dollars as real cash money, liquid US dollars. Think of it in a vault, right? And this is the fractional reserve theory. This is what Keynes and kind of the from the early 1900s up until the mid 1900s. Keynes wrote about this a lot, and there is this multiplication effect with the fractional reserve theory, and the reason for this is demonstrated here in this diagram, where person A deposits $100 at bank A. Well, let's assume there's a 1% reserve requirement. That means that Bank A must hold $1 at all times in a vault. Think of it. Well, what that means is they can loan out $99. Well, once they loan that $99 out into the system, it goes to a different bank who now has $99. Well, their reserve requirement is only 99 cents, meaning they can loan out $98, right? And then that $98 goes out into the system, goes into Bank C, who now only has to hold 98 cents. They can further increase the money supply to 97. They can loan out 97. They can increase the money supply by $97. So as the money works its way through the system, there is a multiplication or money multiplier effect under this fractional reserve theory. There's a chain of deposit creation. And as it works its way through, there's kind of an amplification that gets done and new money is created. This is the fractional reserve theory. Then, of course, there is the financial intermediation theory, which very simply put is just that the dollars are shuffled around from one account to another. I deposit $100 with Wells Fargo. They can only loan out $100, right? You cannot, there's no ability to create new dollars. Well, again, we know that this is incorrect because if we look at M0 versus M2, there's already some amount of dollar creation happening because M0 or official base money is only 5.7 trillion versus 22 trillion of M2. This is the financial intermediation theory, though, would say that that is impossible because the bank can only give out loans for however much money they actually have in deposits. They're, again, just acting as an intermediary, kind of shuffling money from one account to another. Those are the three predominant views. The intermediation, where they're just shuffling money around, fractional reserve, where they can only loan out a certain amount of dollars. They must keep some amount as reserve balances, and the reserve requirement could vary depending on the country and the economic landscape, right? A central bank might decrease the reserve requirement if they're trying to stimulate the banks to lend more money. Of course, as we will see in the US, the reserve requirement, I should note, is 0%. The banks are not required to have any of your money. If you deposit $1 million with Wells Fargo, they are not required to have any of that in reserves, in real vault cash ready to go. So, of course, this would appear, hopefully, to most people as very, very susceptible to a bank run. Because if the bank doesn't have the money that we all think is actually in our checking account, well, that would make banks very prime to a bank run. So he designs an experiment where he will go and request a 200,000 euro loan. And in exchange for this loan, they will allow the researchers to peek behind the bank curtain. They will look at the bank screens, right? The terminals that the bankers are looking at that have the balance sheet, liabilities, and assets. They will they actually recorded all of the directors and people participating in the experiment, but they are basically doing a live experiment of seeing how it all works. Where does the money actually come from? Again, if the financial intermediation theory is correct, then they are just shuffling from one account to another. If they're issuing this 200,000 euro loan, you would expect to see some other account decline by 200,000. If the credit creation theory is correct, you would expect that the bank balance sheet just gets bigger. They just print it out of thin air with no limit, and the bank balance sheet gets bigger because remember, the bank is recording the loan as an asset. Then, of course, with the fractional reserve theory, you would expect to see them either check the reserves that the bank has, this particular bank, check the reserves and to make sure that the reserves are adequate for the purpose of the test. They go around, they ask a bunch of different banks in the UK and Germany. The large banks all decline to cooperate. But what he notes is this doesn't really matter because they all face the same identical European bank regulations. And then it was agreed upon that this person would go get a loan for 200,000. They would photograph and videotape the screens of the bank and the people participating in the writing of this loan, and then they would watch in real time the balance sheet and the behind the curtain of the bank. They would watch in real time how it all works. So of course, what actually happened? The critical question is, where did the bank obtain the funds for that borrower? Remember, we had researcher go and get a 200,000 euro loan. So if the intermediation theory is correct, some other account must have declined by 200,000. But of course, as we will see, that is not actually the results of the study. They also did not check the reserve requirements, which is what fractional reserve theory would require. So here are the results. And again, I will link this in the description so you can read it in full. He has the actual balances and the peek behind the curtain is recorded here in tables. But here we're going to read the results. So starting by analyzing the liability side information, we find that customer deposits are considered a part of the financial institution's balance sheet. This contradicts the financial intermediation theory, which assumes that banks are not special and must keep customer deposits off balance sheet, right? No commingling of funds. This is part of why FTX got into such problems, is that they were commingling funds. And if the financial intermediation theory was correct, you would assume to see that, but they did not. Instead, we find that the bank treats customer deposits as a loan to the bank, recorded as a quote unquote claim by customer, who in turn receives a record of their loan to the bank called a deposit. This can only be reconciled with the credit creation or the fractional reserve theory. So remember, credit creation, they're just printing dollars out of thin air. And then fractional reserve, there's some amount of reserves that they must hold at the bank. Since the fractional reserve hypothesis requires an increase in deposits as a precondition for being able to grant the bank loan, it must precede the bank loan. It is difficult to reconcile this observation with the fractional reserve theory because the reserves did not increase prior to the loan being issued. There was also issue with the liability side. So the liability side account information seems only fully in line with the credit creation theory because again, these reserves were not being checked and they were in fact falling. We observed that reserves fell while claims on customers rose significantly. Moreover, total assets also rose by an amount not dissimilar to our loan balance. Can this information be reconciled with the three theories? Again, considering financial intermediation hypothesis, this is just shuffling around money from one account to another, we would expect a decline in reserves, because remember, that 200,000 euro must come from some other account, of the same amount as customer loans increase. So the loan side is increasing, but some other side must be being drawn down. However, reserves declined by far less than the loan amount. They got a 200,000 euro loan. They saw a significantly lower amount of the reserves came down a lesser degree than you would expect with a 200,000 euro loan. At the same time, the balance sheet expanded, driven by a significant increase in claims on customers. If the bank borrowed money from other banks in order to fund the loan, thus reducing its balance of net claims on other banks, this would be in line with the financial intermediation theory of banking. Vault cash should not increase and neither should the balance sheet. We observe that both a significant rise in cash holdings and an expansion in the total balance sheet. This is assets and liabilities, which rose by an amount not too dissimilar to the amount they asked for, which was 200,000 euros. This cannot be considered, this cannot be thinking of in the intermediation theory and therefore it must be rejected. Considering the fractional reserve theory, we confirmed by asking the credit department that none of them checked the reserve balances or the balance of deposits with other banks before they signed the loan contract and made the funds available to the borrower. So, again, remember, under the fractional reserve theory, you would expect that they would have to go and check their reserves. Well, they didn't check the reserves. You would also expect that if you're increasing the loans, the loan side that you are writing out and creating in new dollars or new euros, you would expect that the reserves would have to rise, right? If there is a reserve requirement and it is actually a binding constraint, you would expect that. But they did not see that. Furthermore, there seems no evidence that reserves, again, this is cash and claims on other financial institutions, declined in an amount commensurate with the loan taken out. So they did not see the reserves decline by an amount commensurate with the amount that the loan was issued, which was 200,000 euros. Finally, the observed increase in the balance sheet can also not be reconciled with standard description of the fractional reserve theory. We must therefore consider it rejected as well and find that basically the bank printed the 200,000 euros out of thin air and did not transfer that money from one account. They literally just created it out of thin air. Then they did some magic accounting and were able to record that loan as an asset on their balance sheet. So again, they didn't check the reserves, so fractional reserve is out. They didn't see a decrease from some other account, so you can't. It's not the intermediation theory because again, that did not. They were not seeing some other account decline by 200,000 euros. And this is only in line with the credit creation theory. The balance sheet grew, and the bank just printed it out of thin air. And of course, this has far-reaching consequences for things like inflation. Here, by the way, is one of the charts we're going to look at in future videos now that we've established banks print money out of thin air and there is no reserve requirement. We also established, by the way, in the US, reserve requirement ratio 0%. And we can see that reflected here. Here's the reserve requirement in red, 0. And we see bank reserves at 3.3 trillion. And so we know this is incorrect. But in future videos, we're going to look at the correlation and the rate of change of some of these different metrics, right? Richard Werner proposed this disaggregated credit theory. And this is something I've been looking at for the past 2-3 weeks or so of finding correlations between certain components of total bank credit, right? So we can look at, say, for example, commercial and industrial loans. We can see, is that fueling GDP growth? You would expect that it would. We can look at real estate loans. Is that driving single family home prices? You would expect that it would if the rate of increase of those real estate loans, right, as the bank can just print as many real estate dollars or loans and therefore dollars as they want, you would expect to see a correlation with the rate of increase of home prices. And all of these things we're going to look at. But I think something that's interesting here is here's the M2 money supply and then deposits. So again, remember that under the kind of intermediation theory, these should be the same. They are just shuffling from one account to another. You should not expect to see M2 money supply growing above deposits. And then here at the bottom, you have what's called a correlation coefficient. So this measures the correlation between these two lines. And the correlation is extremely strong. It is basically 1 for the entire period of time. But look, there are weird periods of time where, for whatever reason, the correlation breaks down. And this is in logarithmic form, by the way, so you can see the gap better down here. Otherwise, it just looks crazy because it's parabolic. So here in logarithmic form, we can see that there are some divergences. And we can see that also as well in the correlation coefficient breaking down. For example, here in the early 80s, which is another period of time the silent depression kind of keeps coming back to. In the early 80s, we can see the correlation broke down. It did not go negative, but deposits actually fell, even though M2, broad money, was increasing, right? And so there are a number of these divergences that happen, and we're going to look at what was going on at these time periods and if there's a correlation to any other metrics that we have looked at in other videos. Here is M2 divided by M0. So this is the rate of change of the broad money relative to the rate of change of the narrow money or the base money or the M0, the official money. What we can see is that M2 grew above and beyond the rate of M0. This is why this line goes up here. But then something happened in the mid 80s and it peaked out. And ever since then, that broad money supply has been it's been increasing, but it's increased at a slower rate than the monetary base. That is why from 85, the mid 80s, all the way through to now, this white line is going down, is because M0, government money, official money, monetary base, has been growing faster than the broad money, which is checkable deposits, time deposits, CD accounts, that sort of thing. And so, of course, in 2008, we can see something very clearly broke. And we've noted this in some of our logarithmic trend analysis of things like personal income, real GDP, and some of those metrics. Something very clearly broke in 2008 in the kind of monetary system as we're looking at it here. M2 just fell off a cliff relative to M0. We can look at the share of GDP of each of these. So here is M2 share of GDP. Here, this chart might look familiar, by the way. This is what personal income on a real purchasing power parity basis looks like. Here in the late 90s, GDP peaked versus M2. What this means is that back here, GDP was 2.2 times the value of the M2 money supply or the broad money supply. As we can see here, it's 1.3, meaning that M2 money supply going back to the mid 90s has increased faster than GDP. Put another way, though, from the 60s up and through the mid 90s, GDP was actually increasing at a faster rate than the M2 money supply. Well, something again, going back to this 90s turning point, something broke and the money supply has been outpacing GDP growth. Well, this is clearly not good. Hopefully that makes intuitive sense. Here is GDP relative to M0. I will take these off so it's a little bit clearer to see. It's very similar to the M2 relative to M0 chart. This is again, if GDP is increasing faster than the monetary base or that government money, you would expect to see the blue line go up. Sure enough, that's what we see up until the mid 80s when it peaks out and declines. Again, you can see something very clearly broke when in 2008, when GDP just fell off a cliff relative to the amount of official government money that was being created by the government. And then finally here, we have that real purchasing power of personal income that I had mentioned that looks strikingly similar to GDP denominated in M2 money supply. And so these are all things that we're going to evaluate in some of the future videos. Look for correlations, look at rate of change of the disaggregated credit components, real estate loans versus commercial loans, that sort of thing. Here, just as kind of a teaser, here's another chart that part of this what I've been working on for this. Here's the rate of change of consumer credit. And what this is referring to is over a 12-month period of time, what percent change over those 12 months on an annualized basis? At what annualized rate is consumer credit growing? And then in red, we have real GDP growth. This is gross domestic product on a year-over-year basis. And hopefully it is very clear there is a very strong correlation between rate of change of consumer credit, remember, so banks printing dollars by extending loans to average Americans, and to real GDP. And we can see that reflected in the correlation coefficient. It is basically 1 the entire time, going all the way up until, again, the 1990s, when we see the first real kind of dip in this correlation coefficient. This is taken over 9 months, by the way. But then as time goes on, we can see it gets even worse and the correlation breaks down even more significantly here again at that late 90s, early 2000s time period, which, by the way, is the peak in GDP denominated in M2 and personal income denominated in M2, money velocity as well, the correlation breaks down. Something really breaks down heading into 2008. Here we can see it would be expected for the correlation to maybe break down in 2008. But as we can see, the correlation breaks down in 2005, 2006. So it starts to break down way before. And again, going back all the way to the 50s, the correlation is extremely strong. And then it starts to break down to an increasing degree. So the rate of change of consumer credit creation, or banks printing dollars by extending loans to average Americans, stops being correlated to real GDP. Again, this is all stuff that we will cover in future videos. Hopefully, this was helpful. Hopefully, you learned a little bit how the financial system actually works and how banks can create money out of thin air. Stay tuned for the next one. I'm going to probably do a couple part series for this one, and I will catch you in that next one.